Silver didn't spike. That's the story. Historic accumulation? Check. Tightening inventories? Yes. Industrial demand exploding for solar, EVs, AI infrastructure? Absolutely. China restricting exports of silver-linked components? Confirmed. Price reaction? Muted. Think about that. When fundamentals scream but price whispers, you're not watching calm. You're watching compression. Pressure building behind a valve that hasn't opened yet. If you're holding silver, stacking physical, or watching this space seriously, understand this. The tell isn't the explosion. It's the silence before it. One dominant player sitting on roughly 750 million ounces. COMEX inventories draining from registered categories. Lease rates refusing to relax. Physical premiums staying elevated even as spot charts look boring. Your job isn't to predict the break. It's to understand the mechanism, so when it moves, you're positioned, not panicking. This is pattern recognition, not hype. Let's go. Quick ask. Subscribe if you're serious about understanding markets from the inside, not from headlines. We track the plumbing, the stuff that doesn't make CNBC until it's already over. That's the community here. Now, the signal. Physical silver tied to COMEX futures? Tightening hard. Registered inventories, the actual metal available for delivery, dropping while eligible supplies sit locked away. That matters because registered is what futures contracts can claim. When that shrinks, delivery pressure builds. At the same time, industrial demand is accelerating beyond forecasts. Solar installations globally, electric vehicle production scaling, AI data centers requiring silver-heavy components. These aren't speculative. They're supply contracts being signed right now. And China just restricted exports of antimony and other materials linked to silver refining and tech applications. Not a full ban, just enough friction to tighten global flows. Here's the hidden layer most people miss. One major financial entity controls around 750 million ounces through derivatives and physical positions. That's not conspiracy. It's disclosed positioning. When one player dominates that much of a market, price discovery breaks. The paper market can suppress volatility and cap rallies while the physical market drains. Lease rates, what it costs to borrow silver, stay elevated. Physical premiums over spot, what you actually pay for real metal, refuse to compress. Those are stress signals. But spot price, grinding sideways, that disconnect is the tell. When paper supply expands to manage price, but physical supply contracts, the system behaves like a sealed valve. Pressure builds quietly. Then something slips. Let me name the mechanism. The pressure valve. Here's how it works. Imagine a water system. Demand increases. More people need water. But instead of raising prices immediately, the utility opens reserves, expands credit for future delivery, sells forward contracts. On paper, supply looks fine. Pressure gauges read normal. But the actual reservoir? Draining. For a while, the system holds. The valve stays shut. Prices stay controlled. Everyone assumes equilibrium. Then one day, someone turns a tap expecting water. Nothing comes out, or a pipe bursts, or the utility announces rationing. Suddenly, price doesn't adjust gradually. It reprices violently to reflect the real scarcity that was hidden behind financial engineering. That's the pressure valve. Not prediction, pattern. Apply it to silver right now. Paper supply, futures contracts, unallocated accounts, ETF shares can expand almost infinitely. You can write a contract promising silver delivery without holding the actual metal. That flexibility gives large players tools to manage price. When physical buying surges, they can sell paper to absorb demand without spiking spot. Works beautifully, until the paper holders want physical. Right now, industrial users are locking forward supply, paying premiums, signing multi-year contracts, accepting higher costs just to guarantee metal. That doesn't happen in loose markets. That's a tell. COMEX registered inventories dropping while eligible sits idle? That's classification games. Eligible means the metal exists in warehouses but isn't available for delivery against futures. Registered means it is. When metal shifts from registered to eligible, it's effectively leaving the delivery pool without leaving the warehouse. Pressure builds. Lease rates staying firm even as spot stalls means someone needs to borrow physical silver now, despite price levels that should indicate plenty of supply. That's friction. That's stress. And here's where most people get trapped. They wait for the chart to confirm the move. By the time the chart screams, the compression phase is over. You're buying the release, not positioning during the build. This pattern repeats across markets. Different asset, same movie. Oil in 2007, palladium in 2019, uranium in 2023, even lumber in 2021. The setup is always similar. Paper markets suppress volatility while physical drains. Calm persists longer than logic suggests. Then the valve opens, through delivery default, policy shock, or demand surge, and price doesn't climb. It leaps. Your job isn't to time the break, can't be done. Your job is to recognize the structure, so you understand what you're watching. Not advice, pattern recognition. Second mechanism compounds the first. The liquidity trap. Large players don't just control price, they control volatility. Low volatility conditions markets. It trains participants to expect slow, predictable movement. Option premiums collapse, retail loses interest, media stops covering it, the crowd disengages. That's not accident, that's positioning phase. While volatility stays suppressed, sophisticated players accumulate quietly, building positions at stable prices without triggering momentum algorithms or attracting attention. They're not buying to pump, they're buying because they see the same physical tightening we just discussed. But here's the trap. When volatility explodes, liquidity vanishes. Imagine you're a market maker. Your job is providing continuous bids and offers, profiting from the spread. In calm markets, that's manageable. Small position risk, predictable flows. Now imagine volatility triples overnight. Suddenly, the risk of holding inventory spikes. You can't price confidently because moves are discontinuous. Gaps appear, so you widen spreads or pull bids entirely. Liquidity, the ability to buy or sell without massive slippage, collapses exactly when late participants need it most. That's the trap. Early entrants positioned during low volatility at tight spreads. Late entrants are forced to react during high volatility with wide spreads and sparse liquidity. The difference in execution quality is brutal. Think about that. The mechanism punishes hesitation asymmetrically. This applies now because silver volatility has been unusually compressed. Historical volatility measures near multi-year lows despite all the fundamental developments we discussed. That's not coincidence. That's someone managing the tape. Futures positioning has quietly flipped. Managed money, the speculative hedge funds tracked by CFTC, shifted from persistent short pressure to stealth accumulation. Not screaming headlines, just position adjustments that show up in weekly reports most people don't read. When these players position, they're not trying to front-run a rally tomorrow. They're structuring for a move they expect will be explosive when it comes, whenever that is. Could reverse, could take months, could unwind gradually instead of violently. No guarantees. But the setup matches previous liquidity traps. Suppressed volatility, quiet accumulation, physical stress signals, positioning flips. By the time headlines change, when Bloomberg or Reuters runs "Silver soars on supply shortage," the move is already spent. The trap has sprung. Entry points that existed during the calm are gone. This is where retail traditionally gets crushed. They wait for confirmation. Confirmation arrives as price acceleration. They chase. Liquidity is thin. Spreads are wide. They're buying the top of the initial leg, right before the first pullback shakes them out. Not a moral judgment. It's structural. The game is designed this way. Your edge, if you build one, comes from recognizing the pattern during the compression phase, not chasing during the release, not telling you to buy, showing you the mechanism. Here's what you need to sit with. The real question isn't will silver move? Wrong framing. The real question, what breaks first? Price control or physical availability? Think through both paths. Path 1. Price control holds. Paper supply keeps expanding. Futures remain liquid. Physical demand gets rationed through premiums and delays, but spot price stays managed. Large players maintain dominance. Retail stays bored. Years pass. In that scenario, physical stackers sit on metal that doesn't appreciate. Opportunity cost compounds. They were right about fundamentals, wrong about timing. Markets can stay broken longer than you can stay patient. Path 2. Physical availability breaks. Industrial user can't source. Mint delays extend. COMEX faces delivery stress. Someone demands metal, and the warehouse is empty. Not because silver disappeared, but because it's locked in eligible, controlled by dominant players, or already committed. In that scenario, price doesn't adjust gradually. It gaps. The valve opens violently. Liquidity vanishes. By the time you see the headlines, you're chasing. The stakes are asymmetric. If you're positioned and nothing happens, you hold metal that retains value. Worst case, opportunity cost. If you're not positioned and the valve opens, you're forced to react in thin liquidity at spiking prices, or you miss it entirely. If you're leveraged wrong, short or selling covered calls, or positioned for continued calm, the move crushes you. Not slowly, fast. So what breaks first? Can't tell you, can't know. But understanding the structure means you're watching the right signals instead of guessing from price action. That's the difference. Let's walk through scenarios and then what to track. First scenario, orderly repricing. Physical tightness persists but stays manageable. Industrial users pay up, stackers wait longer, but no crisis. Price grinds higher over quarters, not days. Volatility rises gradually. This favors patient accumulators who size positions conservatively and aren't forced to react. Second scenario, volatile squeeze. Delivery stress event or sudden policy shock. Price gaps, liquidity thins, premiums explode. This punishes late entrants and over-leveraged shorts. Rewards those positioned early with tight stops or patient physical holdings. Third scenario, extended suppression with sudden shock. Control holds for months or years, then breaks all at once. Fundamentals deteriorate further during the suppression, making the eventual move even more violent. This exhausts bulls who position too early without staying liquid, while rewarding disciplined accumulators who added slowly. No predictions, just paths. Each requires different risk management. Now, the watch list. What I'm tracking this week and this month. First signal is COMEX registered versus eligible inventory. Normal behavior looks like flat drift, slow seasonal adjustments. Stress behavior shows sudden drawdowns in registered, large reclassifications from registered to eligible, metal leaving the delivery pool without leaving the building. How to interpret this? Check CME Group's daily metal stocks report. If registered drops while eligible rises, someone's pulling metal from availability. If both drop, metal is physically leaving warehouses. That's tightening. Where it shows up, delays in delivery, rising futures spreads, premiums widening. Second signal, silver lease rates and physical premiums. Normal behavior means declining during calm markets. Lease rates compress as borrowing demand eases. Physical premiums narrow as supply flows freely. Stress behavior shows rising even as spot stalls. Lease rates climbing means someone urgently needs physical. Premiums staying elevated means retail supply is tight. How to interpret. Compare lease rates, available on Kitco, Bloomberg, to spot price. If spot is flat but lease rates rise, that's stress. Check premiums at major dealers. If they're 10 to 15% over spot instead of 3 to 5%, supply is constrained. Where it shows, mint delays, dealer back orders, long wait times for physical delivery. Third signal, futures curve shape, contango or backwardation. Normal behavior is mild contango. Futures trade slightly above spot, reflecting storage and financing costs. Stress behavior looks like the curve flattening or flipping into backwardation. Near-term contracts trading above deferred. This signals immediate scarcity. How to interpret? Check futures quotes on CME. If front-month silver trades at or above 3-month contracts, physical is tight now. That's rare for silver. Where it shows, delivery scrambles, short covering, volatility spikes. Fourth signal, China export and policy headlines. Normal behavior is silence, occasional long-term strategy announcements. Stress behavior shows additional restrictions, temporary export controls, sudden quota changes. China controls significant refining capacity and antimony production, both critical for silver applications. How to interpret? Don't wait for mainstream headlines. Track official Chinese ministry announcements, trade industry reports. If they tighten further, global supply chains constrict. Where it shows, industrial users locking supply, forward contracts at premiums, refining bottlenecks. Fifth signal, industrial demand announcements. Normal behavior looks like long-term projections, gradual capacity expansion plans. Stress behavior shows emergency sourcing, capacity bottlenecks, companies publicly stating supply concerns, or paying premiums to secure forward contracts. How to interpret? Watch earnings calls from solar manufacturers, EV producers, tech firms building AI infrastructure. If they mention silver supply challenges, that's real demand stress, not speculation. Where it shows, forward pricing surging, multi-year contracts, substitution research announcements. If you're an active trader, respect volatility, size conservatively, use tight stops, don't fight the tape if control persists. If you're a long-term holder, accept pullbacks. Understand your trading time for potential asymmetry. Stay liquid enough to add if the setup improves. If you're watching but not positioned, track these signals weekly. When multiple flip to stress simultaneously, the structure is shifting. Now the risk cluster, how to approach this. Not commands. Just what serious participants historically do during pressure valve markets. 1. Diversify exposure types. Physical, miners, streaming companies, futures. Each responds differently to stress. Physical survives liquidity crunches. Miners amplify moves but carry operational risk. Futures offer leverage but demand active management. 2. Stay humble on timing. Could be weeks, could be quarters. Don't over-leverage assuming immediate moves. 3. Track positioning, not just price. CFTC reports, warehouse data, lease rates, these show structural shifts before charts do. 4. Keep liquidity. If you're fully positioned and the valve opens, you can't add. If you're fully cash and it opens, you're chasing. Balance. 5. Accept volatility. If this moves, it won't be smooth. Prepare mentally for sharp pullbacks even within a larger trend. 6. Know what you own. If you hold physical, understand premiums, storage, liquidity. If you trade futures, understand margin calls, rollover costs, delivery mechanics, not advice, framework. If you're tracking these signals, you're not reacting, you're positioning. That puts you in the group that doesn't panic when headlines finally shift. You've seen the pressure building, you understand the mechanisms, you know what you're watching and why. Most people wait for certainty. Certainty arrives as price confirmation. By then, the structure has already shifted. You're watching the plumbing. That's the edge, not guaranteed. Could reverse. Could take longer than expected. Could unwind through a different path entirely. But understanding the pattern, the pressure valve, the liquidity trap, means next time you see this setup in any market, you recognize it early. That's the skill being built here. So, engagement check. Which signal would worry you most? Registered inventory collapsing, lease rates spiking, or the curve flipping into backwardation? Drop it in the comments. And if you've caught something early before, whether silver, another commodity, a stock, share the story. What did you see that others missed? We're building pattern recognition as a community. Subscribe if you haven't. We're tracking what others ignore, teaching mechanisms that repeat, and positioning ahead of headlines, not chasing them. Final insight. Price is always the last thing to move. Everything else, inventory levels, positioning shifts, physical premiums, industrial announcements, those happen first, quietly. In data, most people don't check. By the time the chart screams, the informed group is already positioned. Your job isn't predicting the break, it's understanding the structure. You're ahead if you're watching now. Let's keep building.